Hey, welcome to the What the Wealthy Do podcast, where we break down the tips, tricks, cheat codes, strategies of the ultra wealthy and show you how you can apply them to your everyday life while you are on your wealth building journey. I am Stephanie Dorsey. I am the host of the podcast, and today we are going to finish our conversation about how the wealthy move money to mitigate their tax liability. This is part 3 of that conversation because we already talked about this. Listen, when the wealthy make their money, they only care about one thing, and that is keeping it. You hear me? And not giving it to Uncle Sam or anyone else to manage it. They want to manage it themselves. But before we jump in, I got to say, this podcast is not intended to give you financial advice. It is intended to give you financial education so that you can make the best decisions for your life while you are on your wealth building journey. I tell everyone, learn from the mistakes of others because life is too short to make them all yourself. So let's see what these jokers are doing and learn from them so that we don't have to pay millions and millions of dollars for their tax strategists and accountants and business managers to figure out these strategies. As I have mentioned over and over again, I will continue to mention this, the ultra wealthy spends a lot of time and money trying to avoid or mitigate their tax liabilities. And they use all kinds of strategies to mitigate their tax liability. And last week we talked about bonus depreciation and cost segregation studies. Today we're going to talk about charitable giving and the state and local tax deduction that was just increased in Trump's big, beautiful tax bill. I love to say it, call it that, because it's so ridiculous. But anyway, his big, beautiful tax bill of 2025. Remember how we talked about the wealthy uses money in all kinds of ways to enrich their lives? Not only saving money, but they also want, there's a certain amount of alignment, enrichment that they seek. Well, charitable donations they're the same thing. Like a lot of times donate money to a particular charity because of the social standing that comes with it. I do want to say, when we talk about improving social standing, if you look at the founder of the Nobel Peace Prize, he was the inventor of dynamite. So he certainly was trying to have changed the legacy that he created with how he made all of his wealth, as well as Rockefeller started the University of Chicago. And Rockefeller was known to be a ruthless businessman. And he did a ton of philanthropic giving as he started to age, and because he was trying to create a different legacy than the one that existed before. Also, obviously, donating capital reduces taxable income, right? You get to write that off on your taxes, and they get to work on and donate to a charity that they care for and work that they care for. When you think about the fact that Warren Buffett is trying to get 100 other billionaires to donate the vast majority of their wealth to charities they care for, the argument there is they believe that if they donated to the right charity, that could have more of an outsized impact on making this world a better place than potentially the money just sitting with their heirs, or certainly just sitting with the government. We clearly know that. So this is part of the reason why they donate. But let's talk about what you can do to mitigate your tax liabilities if you're not writing multi-million-dollar checks or even, six-figure checks. Actually, before that, us W-2 earners, we have to file taxes every year, and there is a certain threshold that we have to be aware of. And that the threshold that I'm talking about is the threshold that you meet where you either get to do a standard deduction on your tax returns or an itemized deduction on your tax returns. And as of 2023, as a single person, you either had to write off more than $14,500 in a year in order to qualify for an itemized deduction. As a married person, that number is $29,200 for a year. So if all of your deductions, your charitable givings and your expenses and your house interest expense and all of that, your student loan interest expense, if that does not get you to, as a single person, the level of $14,000, then you only get a standard deduction, which is $14,000. But if You can exceed that, and you can if, for instance, you're an investor. We talked about bonus depreciation potentially, and now we're going to talk about some stuff today that might get you over the hump. And so think about charitable giving. You may or may not be writing a check for $15,000 a year if you're a single person. If you are not, what you can do is use what is called a donor advised fund. And so, say for instance, a donor advised fund is a charitable giving account that allows individuals to contribute cash or securities, so stocks, or any other assets. So you can go, like Fidelity will have one, Charles Schwab will have one, any of them will have one. And the donor advised fund, you can give it to anything. So you can do your tithes, your church tithes. If it's not already listed in there, you can just add so-and-so, AME, whatever church to your donor advised fund, and then every week or however frequently you want to give to that church, you can do that through that fund. What you would do is, say you had a really massive year this year, 2025, you got this crazy bonus for $100,000. You're like, what do I do with this bonus? I don't know. Well, one thing you can do is take a big chunk of it, $25,000, $50,000, and give it to a donor advised fund, right? And then what you can do is write off that big check, that big ass check for 25K or 50K when you file your 2025 taxes. But the key is you get to write it off in the year that you make the donation, but you don't have to donate all of that $25,000 or $50,000 in the year that you made the donation. Does that make sense? So you donated in 2025, you write it off in 2025 when you do your taxes. However, you can make donations from that donor advised fund account in 2026, 2027, and as long as you want, you get to do that. And so that is a wonderful hack to pool all of your donations together so that you can get the benefit of making those donations in one year, because you may or may not from year to year meet that standard deduction threshold. Okay. Another thing you can do in your donor advised fund is, say for instance, you have some stock. You bought some NVIDIA stock and it's went crazy, but you decide you're going to have a really, really good year this year, and you need to figure out a way to offset some of your tax liability. What you can do is donate your stock. So remember I said that donor advised fund could take cash, it could take securities or any other assets. You can donate your stock into that donor advised fund, and it will take the market value of that stock today. So even though, for instance, you spent $1,000 on NVIDIA stock 5 years ago, and now it's worth, I'm literally making these numbers up because I have not done the math on this, but now that $1,000, I think NVIDIA is up like 3,000% or something. It's like some stupid number, but say that $1,000 is now worth $15,000. You get to invest that $1,000 worth of stock, I don't know how many shares it is, into your donor advised fund, and the market rate of that stock you get to write off on your taxes on the year you invested it or you moved it over to your donor advised fund. Now this is great because not only you are getting the tax write-off by making this donation, you're also avoiding capital gains tax for the value of it, right? To use it any other way, like you would have had to sell it and potentially pay capital gains tax, or you could take a loan out on it because we talked about that too, right? So donor advised funds are your friend, and they're something for you to keep in your back pocket to use whenever you need to mitigate a massive tax bill that you're gonna have. And the last thing about donor advised funds, again, say for instance, you put in $25,000 or $50,000 into that donor advised fund, but for the year 2025, you really only need to use $5,000 of that or $10,000 of that. you get to carry it over to 2026 when you file your taxes, or 2027 when you file your taxes. So you get to carry over losses or write-offs. You don't have to use them all in that year. So again, strategy comes into play when you're thinking about the things that you have to take care of. All right. The second and last thing I want to talk about from a tax perspective, and that is SALT, or state and local tax deduction. Again, if you itemize your tax breaks, you get to claim a SALT deduction. And what is that? That is if you live in a state where there's really high taxes. So you live in California, New York, or whatever, and they have high local and state taxes. Philly, my Philly cats. And with Trump's new big beautiful tax bill for 2025, they have allowed you to write off $40,000 in 1 year. That's starting in 2025, and it's going to keep going up with a 1% increase up until 2029. And then in 2030, it's going to revert down to $10,000. So for the next 4 years, you get the benefit of this massive deduction. And so what does that mean? There is another limitation. That 40% SALT cap, it starts to phase out once you reach a modified adjusted gross income of over $500,000. So this is for my people who are in the top 2 to 20% of income earners. Like, this is your jam. Actually, yeah. So like all the folks that are making $200,000 or $300,000, $500,000, and they live in like California or these very expensive high tax states, this is for you. And obviously your modified adjusted gross income, you are going to do things, because we've already talked about lowering your taxable income, to make sure that if you're close, you can legally do some things to make sure that modified adjusted gross income falls at below $500,000. I am certain that you and your accountant or your tax strategist can make that work. If not, keep thinking about it and figure that out, because please know that the ultra wealthy are doing that. But here's an example. Say you live in California, you make $250,000 a year. The California state tax is 9.3%. That is about $23,250 in SALT taxes. And if you do the math on that, that's $23,250 in SALT tax deduction that you get to take based on your income, assuming that you qualify. And so deducting that $23,000, it lowers your taxable income on your federal return by that same amount, right? So you still got to pay California, but you get to write it off, and you only pay it once. You get to use it as a write-off on your federal tax return. And so that's huge. Again, I'm not a CPA. Talk to your tax strategist, talk to your CPA, your tax preparer, to figure out the best way for you to use it. But I say all this because I too struggled with this presidency, and I struggled with all the people that are being hurt by this administration. But I am an optimist at heart. I'm going to look for that silver lining. I just am. And so I think just, thinking about the fact that I am on my wealth building journey, and it is important to me that all of the people in my community, which is y'all, get to take advantage and get to build wealth right along with me. I think about the silver lining with this administration is we too get to build wealth, right? And that means that we get to have freedom. And that means that we get to have optionality in case we need to dip or whatever, however we want to live. And so it was important to me to do this series, because I wanted you all to see that we gonna make our lemonade, because that's just what we do, right? And this is an opportunity for us to make lemonade, even though a lot of people are hurting. Again, today, we talked about the use of donor advised funds. We also talked about the new SALT deduction that was significantly increased with this new tax bill. Again, the tax code rewards risk takers. It rewards businesses and investors. Unfortunately, not too many high income earners, which a lot of us live in that space. But when you know better, you do better. And so that's what we're going to do. So yeah, it's not a cheat code. It's the code. It is the way that wealth people are making a ton of money. And we too are going to use this to increase our wealth. So if this conversation was helpful, please share it with a friend, like, subscribe, comment, give me a 5-star review, and I will see you next week. Bye.